We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Pento from Pento Portfolio Strategies. Thanks for joining me today, Michael.
Thanks for having me on the show, Tom.
Excellent to have you back and get some of your thoughts here as well. So the economic model that you have created has had you long inflation and growth into the early part of 2021 and turned more to a disinflationary posture since then. So can you explain why this pivot came when it did?
That's a great question. So one of the most important components of the model, we have 10 for inflation, deflation dynamic, and 10 for growth, recession dynamic. I look at changes in fiscal and monetary policies to let me know what I should be positioned for. And then I have the other 18 components to let me know if I'm correct in that assumption. So what's going to change later in 2021, which we're pretty much, we're in the latter half of it right now, and especially in 22, is a gigantic, monstrous fiscal and monetary cliff like we've never seen before. So like I say many times, there were $6 trillion spent between March of 2020 and March of 2021. Fiscal stimulus, they call it. $4 trillion of that was monetized by the Federal Reserve. Helicopter money was deployed for the first time. Well, in 2022, and that's by the way, it's about 25% of GDP. In 2022, it's going to be about 2% at best of GDP is going to be thrown out to people in the economy. And the Fed is going from an incredible $1.44 trillion a year in debt monetization to zero in 2022. And I just don't think, I've been in this business 31 years. I just don't think that the stock market that's trading at over 2 times underlying economy, which has never before happened, not even close. It's usually about 0.7% of 70% of the economy. Now it's 200% of the economy. I just don't think the stock market can hold up unless it has a constant infusion of $120 billion a month of money printing. And I'll add to that about 25% of all companies are zombie companies, have to issue debt just to pay interest on existing debt, issue new debt. Well, when the credit market begins to freeze up, and I'm sure it will in 2022, how are these companies going to survive? These companies should have gone the way of the buggy whip, the dodo bird, but they're kept alive on the life support of the Federal Reserve. That is going to end in 2022, and we will find out who has a sustainable business model and who does not. And I suspect many of them do not.
Michael, once this fiscal and monetary cliff comes in, will the Biden administration do anything and everything possible to avoid this pain and avoid basically cutting the population and the economy off of this easy money?
Oh, of course they will. Well, that's why I have a dynamic strategy. So in arrears, ex post, what does the government do? They pass, the TARP program failed in 2008, and then it was passed, $700 billion. Well, first, the economy falls off a cliff in 2020, goes down 30%, the stock market gets wiped out. And then they come in and rescue the economy and the markets with massive money printing and cutting interest rates. But they're running out of that game is getting old. I just have to mention to you again, remind you that there isn't a greater government on this planet that has more control over their economy than China, the People's Bank of China and the government of Xi Jinping. Well, that stock market topped in 2007 and is still down 40%. So just because you have a government that has a desire to make everything right and make the stock market go up, does not mean that it happens. Let's turn to their neighbors in Japan. That market peaked in 1989. And it's still 30% below where it was. So yeah, you either have the desire to create perpetual bull markets, but there's consequences to that. One of the consequences that we've learned this year is inflation. They finally figured it out, where I've been telling them over and over and over again, the Federal Reserve. If you want inflation, what you need to do is hand people money directly. Don't just bail out Wall Street creating deposits for the primary dealers. Give people money directly. They stop producing, they stop working, they have all of the spending power, and they go out and buy things, creating bottlenecks and runaway inflation. I mean, look at the producer price index that came out today. You know, we're close to double-digit inflation. That's going to roll over because this is what happened already. We've already had helicopter money, multiple iterations of thousands of dollars handed out to families. All this comes to an end in January, and that includes mortgage forbearance, student loan forbearance, helicopter money, child tax credits. All of that ends in January. Then I expect to enter into a short period of disinflation, which probably will become deflation, which will cause the stock market to tumble and the credit markets to freeze. And then governments will say, hey, you know, let's do something. Right now, Joe Manchin, the senator from West Virginia, isn't going to pass a $3.5 trillion infrastructure package. He probably will go along with it when the stock market is crumbling and his constituents in West Virginia are saying, hey, you better do something. We better start printing money. But here's the point, Tom. What have we done to reconcile the imbalances and remediate the problem that was extant prior to the great pandemic? What have we done? I mean, we still have asset bubbles. They're even bigger than they ever were before. We still have a Federal Reserve that has distorted and morphed interest rates greater than at any time in history. You know, it took 107 years for the Fed's balance sheet to reach $4.1 trillion. 107 years. They did another $4.1 trillion in 5 quarters. Look at the debt we have with this nation. The debt of this country now, total non-financial debt, increased 17%, up $7.7 trillion in the last 5 quarters. So we have more debt, we have more asset bubbles, greater distortion in monetary policy, and higher taxes are on the way. Real wages are falling. Productivity has been wiped out. I mean, productivity was soaring for a little while last year because of distortions in the way they calculate it, but now it's right back down to 2%. You know, you don't create productivity in a viable, sustainable economy, a robust economy, by undergoing a socialist experiment in helicopter money. I mean, why did they give money to people who never lost their job? Why did they pay people more not to work than if they had a job? So we could argue as to, you know, well, of course you had to help people, Mr. Pento. These people got thrown out of employment, gainful job, for no fault of their own. But why are we still doing that? I mean, that doesn't end until September 6th, enhanced unemployment in all the states. Why are we still in an emergency situation, still printing $120 billion a month in an economy with nominal GDP that is double digits? So this is my point.
Absolutely, Michael. And in one of your recent articles, you wrote about that, you know, doubling of the U.S. debt in 5 quarters over what took it 107 years to get to that point, right? So when does that question of the solvency of the U.S. financial system start to come into play if that trajectory of this growth of the money supply continues?
Well, look at Japan. I mean, Japan is in a much worse condition than the United States, and you know they have a 10-year note that's pretty much zero, a 10-year note yield that's zero. So what I wrote about and what I believe is happening is you have the death of markets. Markets have been vanquished and extinguished. There's no free market anymore in anything. I mean, look at the value of real estate. We have here down in Naples, Florida, the value of your real estate market has pretty much doubled in the past 18 months. So how is that sustainable? I mean, the Fed claims to care about the middle class and lower classes, but what about the guy who's renting and he's trying to find a house, a first-time home buyer? What does he do? Where's the Fed introspective and say to itself, Why am I creating all this inflation and destroying real wages? Wages nominally are going up, but in real terms, they're falling. So the middle class is becoming eviscerated. So you asked the question, when do the credit markets care? They'll care, I believe they'll care, when the United States of America adopts some sort of universal basic income in perpetuity. So they'll just say anybody who makes less than a family who makes less than $150,000 a year will get $3,000 a month. I'm just making numbers up, but this is not exactly that. I'm sure they'll come up with something a little different, but it's going to be similar to that. And then the Fed agrees to monetize that forever and never drain its balance sheet. And then you might get some kind of permanent inflation, not the temporary inflation that we had, temporary and destructive inflation. And when I say temporary, Tom, what I mean is that the level of prices is going to stay where it is. It's not going to go back down. But inflation is all about rate of change. Mm-hmm. So if you're asking me, is the rate of change of inflation going to go up 6 or 7% per annum now? Not a chance. Not now, not in this current construct. But in the future, it could, if we adopt the form of universal basic income that I see coming. And that's where you're going to get your intractable, perpetual inflation, which could and should destroy the bond market in the United States of America.
So when we think about your, let's say, your shift away from gold that you really started with in August of 2020, when we get this deflationary depression, as you named it, or as you talk about it, what are the 4 things that will work in that scenario?
Okay, so there's only 4 things historically proven to work when you have a deflationary depression / liquidity crisis. Only 4. See, cash works really well. Short-term treasuries work really well. The US dollar tends to rise because it's a heavily shorted currency in carry trades. So people have to sell their whatever, Australian dollars and have to buy back US dollars or Singapore dollars, whatever they're investing in, they have to buy back the dollar, close out that carry trade. So it's just a surge for dollars. And the 4th thing is shorting the market. Shorting the market works really well in a liquidity crisis. And I think it worked really well in 2008. It worked really well in 2020. It worked really well even in 2018 when we had the Russell fell 30% in the late summer. I think it's going to work the best it's ever done in the next crisis because the heights from which we're going to fall, the cascade, the toboggan ride down is unprecedented. And I think it's going to be really fast. So I will be, my clients hopefully will be ahead of time. Not too far ahead of time, because you can't do it too far ahead of time. You'll lose too much principal, but you can't wait too long either because it's going to happen really fast. So I will be short credit, and because I think those spreads are going to blow out to treasuries, and I will be short equities, especially small caps.
So transitioning, making these changes in your portfolio, Michael, does this, let's say, this current environment change any of your long-term thesis on gold? Well,
gold is, I believe eventually it's going to go to $6,000 an ounce. But gold, you have to understand. I'm a gold bug at heart. Mm-hmm. I believe I am. But gold will rip your heart out if you don't get the timing correct. Mm-hmm. If you own gold from 2008 to 2011, you destroyed the S&P 500. But if you own it from 2011 to 2016, you were borderline suicide. And from 2000, this year is 2020 to this current interview, has not done very well. You could have bought almost anything else and outperformed gold. But still, over the last 20 years, gold has outperformed the S&P 500, ex-dividends. So it's an absolutely essential thing to hold and own. I always recommend 5% physical gold of your net worth that you have access to. And then I toggle the remaining balance between 0 and 20% in my portfolio, depending upon the prevailing macroeconomic environment. And if you own gold when growth in the United States is surging, even if inflation is surging right alongside of it, you're going to get very disappointed owning gold, because gold does not like rising nominal rates and rising real interest rates. But if you own gold when growth begins to slow, as I believe it will in 2022, precipitously, as I mentioned, then gold should absolutely way outperform the S&P 500 or virtually any other index that you measure it against. So I'm an active manager. I try to be smart about the timing. Like as I said, if you own gold the last 20 years, you've done great, even compared to the S&P 500. But if your entry point was 2011 or 2012, you're not too happy. Or if your entry point was April of 2021, 2020, you're not too happy either. So gold does not like liquidity crises either. So that's why you say, someone might be asking themselves, well, why did Mr. Pento pick gold as something to own during a deflationary depression? Because people sell whatever they can. The shadow banking system, hedge funds, pension funds, they sell whatever they can to get a hold of liquidity, which is dollars, cash, short-term treasuries. That's what they need. So gold tends to plunge. Look what happened in the fall of you could have gotten everything right about 2008, the credit crisis, but if you held gold in the fall of 2008, you were very disappointed. It recovered quickly once the Fed, reliquefied the system. And the same thing in 2020. You say, well, what happened? Why was gold going down? Because bond yields were soaring until the Fed, brought down the volatility, the MOVE index in fixed income. So it's just, not that I'm perfect. I make plenty of mistakes, but I get a lot of things right too. And one of the things you want to really get right is gold. And it's not that hard if you understand where the economy is heading.
It can be a tool in your toolbox, and to be just religious about it is like you say, it's not always going to serve you. In some circumstances it could, but not always going to. A caveat, Tom, is like I said, if you don't have any gold in your portfolio, just get 5% and put it away for your grandkids in physical gold. So it's a way of preserving your purchasing power over decades, hundreds of thousands of years. It's like an heirloom. Mm-hmm. I would start there. But as far as your investing concerns go, you have to toggle that between 0 and 20, in my opinion. Absolutely. Michael, you and I have talked before about the bond crisis that you see coming. So what signals would we need to be looking for to see the start of that, and how would it play out?
Well, I mean, one of the components of my model, I look at the MOVE index, which is it's a volatility index for bonds. So I want to see what's going to start to shake that up, right? It's been quiescent for many, many quarters since 2020. But like I said, one of the things I'm looking for is for the government to mollify the current deflation, recession / depression with the universal basic income and helicopter money. So that's something like that would really shake up the bond market, because, I mean, the bond market would understand. I believe right now, as I sit here in this interview, I believe the bond market would finally understand that we are going to set a course for intractable inflation. And, you just can't have, Tom, you just can't have a 30-year treasury note, 30-year, going all the way out along the yield curve, 30-year treasury, duration bonds, yielding 2%, a 10-year note yielding 1.2%, Fed funds and short-term rates almost 0, when inflation is going to run double digits. It's just totally antithetical. I mean, why would anybody accept that? Once the bond market is inculcated into the fact that inflation will never go back down to normal, the Fed will monetize trillions of dollars of helicopter money, which is given out through the Treasury. If that indeed happens, I expect rates to skyrocket. And if that's the case, you're going to have a condition more looking like stagflation than booming economic growth. Because listen, if printing a lot of money and handing it to people work, then Zimbabwe and Weimar Germany and Hungary, post World War II would have been one, and Weimar Germany post World War I would have been wonderful examples of economic growth and sustainable economies. But it's just not. It just doesn't work that way. I wish it did, but it doesn't. A government might wish it does. The only thing that's going to save us is the fact that we are not a banana republic yet. So we have the world's reserve currency. So we're not going to have hyperinflation like you saw in Hungary with the Hungarian pengo, millions of percent. But look at Rome. I've studied, the Roman history of inflation. They were the world superpower. There certainly wasn't a need to trade the denarii, with China every second of the day, but they had 1,000% inflation because the denarii was being debased. That's where they were taking the silver and gold, precious metals out of the denarii and putting other metals in it, debasing the currency, which is exactly what we're doing today. We're diluting the supply. So you can get very high rates of inflation without even if you are the world's reserve currency, you can still get very high rates of inflation. And what would bond yields be under a scenario of 1,000% inflation? And never mind 1,000% inflation, even if it was just double-digit inflation, perpetually speaking, where do you think the bond yield should be? I can tell you one thing. I have no idea exactly where they will go, but keeping them below 2% out on the yield curve is ridiculous. And by the way, one more thing. What does a rapidly rising, inexorably rising bond market, as far as yields are concerned, so prices down, yields up, what does that do to the stock market? That's where I keep mentioning, don't be surprised if the next time we have a market crash, that the market doesn't automatically bounce back right away. And it doesn't bounce back evenly. In other words, not everything is going to rise. You have to know what to own in stagflation rather than, just buying the broad market.
And as I've heard you say before, the bond market is a lot smarter than the stock market. And once it figures these things out, that's when the proverbial crap is really going to hit the fan, right?
Well, I was one of the few people who wrote a book called The Coming Bond Market Collapse. I think I'm the only person who wrote that book. I'm one of the few people who understand that the Treasury market is unsustainable. The solvency of the Treasury is questionable at best. But I was still long duration almost this entire year, and profitably, I might add. So going long duration bonds, because the bond market got it right. The bond market understands that in the rates of inflation on the second derivative basis are going to be coming down. It understands that. So that's why you see yields have been falling this year, even though you have some eye-popping numbers coming out from the Labor Department. And even in non-farm payrolls, which, by the way, I just have to add to this interview that while the rest of the Wall Street was, absolutely amazed about how strong the July non-farm payroll report number was, it should be also out there promulgated that we actually lost jobs in July. So it was all seasonal adjustments that made the number so huge. So when Wall Street said, I hear people on CNBS saying, all these people, million people almost have jobs, and now they can go out and spend money. No, there's less people than June out there. And the people that did get money from their paycheck usually just exchange that for their enhanced unemployment check, which they were making more money. So I don't see this big increase in purchasing power and spending power that's portrayed by the Labor Department. In fact, one more thing about this, if you actually look into the data from the Labor Department, go on their website, bls.gov, they actually tell you, hey, we have a huge problem this month calculating the educational jobs. There was like 260 something thousand educational jobs they just threw in there. but they actually admit, but I don't think that's actually an accurate number because these people weren't hired in the first place due to COVID. So they weren't there to lay off. So we didn't have to put the numbers, we didn't have to boost the numbers. So.
Yeah, it always seems really interesting how they come up with these numbers and really report these metrics, right? Yeah,
I mean, I actually spent some time on the phone with the labor department. I asked them, why couldn't you just make an exception to your model? And they said, we don't change the model just for, just willy-nilly. We make major shifts to the model over long periods of time, not just because of COVID, which I think they should do. Because if you're out there believing that inflation is going to run rampant because the amount of jobs and the hiring in the private sector is soaring, you've got bad info. It's not. I don't think it's. I just don't see it happening.
Mm-hmm. Yeah, and it's impossible to work off data that isn't accurate, right?
Well, you have to find out the accurate data and work off that, which is what I do.
Yeah. Michael, I know we're long on time here. I really appreciate your time today. Of course, you're available at pentoport.com. Anywhere else you'd like to point subscribers to?
Well, you can go to my website, as you say, pentoport.com. There's a free trial, 5 weeks for my podcast called the Midweek Reality Check. If you have around $100,000 to invest, I'll actually put you in the IDEC portfolio, inflation, deflation, and economic cycle model and portfolio strategy. So you'll be able to hopefully, God willing, what we try to do is write out these asset bubbles as safely as possible, but also we keep one eye out for the emergency exit door based on that model that I created. So I know when it's really going to get ugly out there, and I will run to the 4 horsemen of the apocalypse, as I like to call the 4 horsemen of the Wall Street apocalypse when necessary. Because you don't want to suffer another 30 to 50 or maybe even 80% drawdown in stocks if you don't have to. And it may not, I'm saying this to you, it may not bounce back as quickly as most people claim it will, because the Fed always has your back. The Fed is out of room to lower interest rates, and they're already printing money like mad. So what are they really going to do to save you, other than adopting that UBI, perpetual UBI, and perpetual debt monetization, which takes time. It takes time. And we don't want to sit here and watch our retirement go down the drain. Work too hard for that. And I'm not interested in doing that here.
Thank you so much for your time today. I really appreciate it.
My pleasure, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.